Well, did you ever feel this situation and you said to yourself, wait a minute, this doesn't feel right? You open a letter or you log into your tax account and suddenly your stomach tightens. You are not careless with money. You are not reckless. You are retired. You planned for this stage of life, and yet the numbers staring back at you don't match what you expected. You thought retirement meant fewer surprises, fewer forms, fewer shocks. But when it comes to taxes, many seniors are now feeling the opposite. Confused, uncertain, quietly worried, especially now as more people hear about something called the new senior tax deduction and ask the same question in private. Does this help me, or am I about to miss it? Before we go any further, I need to say this clearly so we stay grounded and informed. Before we begin, this video is for educational purposes only. I'm not a lawyer, and laws can vary by state. My goal is to help you understand the situation calmly so you can make informed decisions. Please stay with me until the end because I will give you a clear checklist of what to double check before you file. And I will also direct you to important institutions that can help if something goes wrong. And if content like this helps you, please like and subscribe so I can continue covering the financial issues most seniors are coping with right now, but rarely get explained clearly. And always remember, our rights do not expire with age. Here's the uncomfortable truth. Right now, millions of seniors believe they qualify for new or expanded tax deductions simply because they are retired, over a certain age, or receiving Social Security. But many of them do not. And even more troubling, many seniors who do qualify never receive the full benefit, not because they did anything wrong, but because the rules are layered, technical, and quietly changing. This isn't about beating the system. It's about understanding a system that keeps shifting while your income stays fixed. When you live on a set monthly amount, even a few $100s in unexpected taxes can feel like punishment. Property taxes rise, insurance premiums climb, medical costs never seem to go down. And yet, the tax code changes year after year. That's why this matters now more than ever. So let's slow this down. When people talk about the new senior tax deduction, they are usually referring to recent federal changes that expand tax relief for older Americans, especially those age 65 and older. In mid-2025, Congress passed legislation that created a temporary senior bonus deduction available for tax years 2025 through 2028. This means it affects the returns seniors are filing now and in the next few years. Under this rule, if you are 65 or older by the end of the tax year, you may be eligible for an additional deduction of up to $6,000 on top of the regular standard deduction. If you are married and both spouses are 65 or older, that bonus can be up to $12,000 combined. That sounds like a lifeline, and for some seniors, it is. But here is where confusion sets in. This deduction is not automatic. It is not guaranteed, and it is income sensitive. For single filers, the deduction begins to phase out once modified adjusted gross income rises above a certain level. For married couples filing jointly, the phase out starts at a higher threshold. That means a pension increase, a larger retirement withdrawal, or selling investments can quietly reduce or eliminate this benefit without you realizing it. And here is another detail many seniors miss. This new $6,000 deduction stacks on top of the existing age-based standard deduction that seniors already receive. That means the potential tax reduction can be significant, but only if income stays within the qualifying range and everything is reported correctly. The tax system does not look at how tight your budget feels. It looks at categories: pensions, Social Security, retirement account withdrawals, interest income, part-time work, and required minimum distributions are all treated differently. two seniors living on the same street, the same age, both retired, can have completely different tax results. This is where fear creeps in, quietly at first, then all at once. Many seniors only discover they did not qualify after they file their return, or worse, weeks later, when a letter arrives in the mail. Not a dramatic letter, not a threatening one, just a plain envelope with careful wording that says you owe more than expected. And in that moment, your heart sinks, because by then, the money is already gone. It did not go to anything extravagant. It went to groceries that cost more every month, prescriptions you cannot skip, a repair that could not wait, helping a child or grandchild who needed support. That money was not sitting in an account. It was already doing its job. What makes this so hard is not just the amount. It is the timing. Seniors do not have the luxury of simply working extra hours to fix a mistake. There is no quick reset button. Every dollar has a purpose, and every surprise feels heavier when income is fixed. The thought of paying more taxes feels less like a calculation and more like a threat to stability. Sleep gets lighter, stress lingers. You start replaying decisions in your head, wondering what you missed, what you misunderstood, what no one explained. And the most painful part is this. Many seniors blame themselves. They assume they did something wrong. They feel embarrassed to ask questions. They hesitate to reach out for help. But the truth is, most of these situations are not caused by carelessness. They are caused by complex rules colliding with real life. A single withdrawal, a one-time event, a threshold you did not know existed. None of that feels reckless. It feels responsible. That is why understanding who qualifies and who does not before you file is not just helpful. It is protective. It protects your peace of mind. It protects your ability to plan. It protects you from learning the rules the hardest way possible, after the money is gone and the choices are limited. Knowledge does not eliminate every risk, but it replaces panic with preparation. And for seniors, preparation is not about perfection. It is about security. Let's talk about the most common reasons seniors lose this deduction without realizing it. The first is income thresholds, but not income the way most people think. The IRS looks at combined and adjusted income. That includes taxable portions of Social Security, retirement account withdrawals, pensions, investment income, and even one-time events. A single large withdrawal to cover medical costs or help family can push income just high enough to reduce or erase the deduction. Another major factor is filing status. Married filing jointly, married filing separately, or filing as a single individual can dramatically change how deductions apply. Many seniors keep the same filing status for years without realizing the rules around it have changed. Social Security adds another layer of confusion. Some seniors believe it is never taxable. Others believe it always is. The truth is in between. Once Social Security becomes partially taxable, it raises adjusted income, which can reduce eligibility for senior deductions. This catches many retirees off guard because nothing feels different financially, yet the tax outcome changes. Another issue seniors rarely hear about is state taxes. Not all states follow federal rules. Some states do not recognize this senior bonus deduction at all. Others require add-backs that reduce state-level benefits. That means your federal return may look better, while your state return does not. Without planning, that difference can lead to unexpected bills. This is where control comes back. The goal is not fear for fear's sake. The goal is protection through clarity. When seniors understand how these deductions really work, they can plan withdrawals, time income, and avoid surprises. They can ask the right questions before filing instead of reacting afterward. Now stay with me, because this is the part most seniors wish someone had looked them in the eye and explained before they ever filed another return. This is not a technical checklist meant for accountants. This is a real-life, senior-friendly checklist designed to help you catch problems before they turn into stress, letters, or unexpected bills. First, identify every type of income you receive, not just the total number at the bottom of the page. Social Security, pensions, retirement account withdrawals, part-time work, interest, dividends, and required minimum distributions are all treated differently by the tax system. Two incomes that feel the same in your budget can be taxed very differently. Knowing the type of income matters just as much as knowing the amount. Second, look closely for one-time income events. Selling investments, taking a larger withdrawal to cover medical costs, cashing out savings, or helping family can quietly change your tax picture. These events often push income over a hidden threshold and affect deductions without warning. If something unusual happened that year, flag it mentally. Third, review your filing status every single year. Do not assume the choice you made years ago is still the best one today. Changes in household income, spousal benefits, or living arrangements can shift which filing status works in your favor. Fourth, confirm medical expenses and property taxes are fully documented. Many seniors miss deductions simply because paperwork is incomplete. Keep receipts, statements, and summaries in one place so nothing is forgotten. Fifth, never assume a deduction applies automatically just because you qualify by age. Most senior deductions require correct reporting. Age opens the door, but paperwork walks you through it. Sixth, keep every tax letter and notice, even the ones that look routine. Changes often show up there first, quietly, before they become bigger issues. And seventh, if anything looks different from last year, do not ignore it. Differences are rarely random. They are signals. Catching them early turns confusion into control and fear into preparation. I want to be very clear as we close. This is not about gaming the system. It is about protecting yourself in a system that does not slow down just because you are older. The tax code does not adjust for stress, fear, or fixed income. It responds to numbers on a form. When seniors understand those numbers, fear turns into preparation, and preparation is what protects your peace of mind. Please like and subscribe so I can continue breaking down complex financial changes that directly affect seniors. I read all comments and emails personally, so do not hesitate to share your experience. Did this deduction help you, confuse you, or catch you by surprise? Your story may help another senior avoid a costly mistake. And always remember, our rights do not expire with age. Stay informed, stay calm, and I will see you in the next one.